Here we go. We're going to show people once again. This is a 1080 put that was buyable over here at $1.55, and right now the daily high was $8, and that was the wholesale price down here. When the S&P sold off Friday, we gapped up. Now, why are we looking at the 1080 put? Because if we break below the last lows that I did on stockmarketfunding.com on the index itself, so you have to go fetch that video, take a look at the analysis there, that if we break down through it, we got more upside here. And we have a expiration that's going to expire on 9/17. So there's only so many days left to the third calendar week monthly expiration. And when we take a look at the S&P, this one over here, I'm going to show you, this is the $1,100 put that was also buyable, but notice that the $1,100 put, the low was only $225, and if you are really paying attention to these premiums, the low here was $1.55 on the 1080 once again. So when we take a look at the 1100, 225, Friday's high was $11.90. There was a big trade. That's $9. You got these put options when the index is reversing, you make great money. But what we're going to be looking at moving forward is, should we break the low of the daily S&P 500 using the 60-minute chart, is how we would take advantage, is that we were inflated up here at $50 a contract on the put side. We got down here to very deflated areas at 2.25 where the wholesale buying takes place, and that was a huge up move. That's like $9 in the contract. These 30 contracts down there for about $6,500, and you get a $9 move. Well, that's $27,000 profit in 2 days on using the index. This video will go with the index, how to weight the index, how to weight the S&P 500 index. Go look at those videos that were due today to apply these trades. So we're going to be looking at how we get that bottom side entry and that top side up. If we break the key levels that we set in that S&P 500 video, which is about 18 minutes long, then this side of the market still has a lot of upside. Once they peaked, they did the super peak on that 1080 put, boy, they were up here at the highs of about $43 a contract and $1.55 here. Well, that was inflated, and since we started another reversal in the S&P, we hit an all-time very good low down here. That's where the risk on trade comes into play. And then we took a look at another call that if the S&P was to get weighted correctly, we would look at up and out of the money. A 1250 call that we've been bidding on, the low was 45 cents. We're out to buy this one at 15 pennies now. And that if the indexes want to bounce and go up, you need to have this entry because it's cheap for volatility. Volatility gap open up, gaps the contracts back up. On the other hand, if you gap down, you go down, and we can get hit at that value. Another one that we're going to be looking at is the current 1155 call, which is down here at its all-time bottoms now. Remember that some of these contracts and the pricing mechanism controls that these people use, that high there was $66. You can see here where that low was $22, and you got a super pop gap up to 51. You had 3 contracts here, you made a lot of money. But then they've gapped right back down here, and because of the volatility in pre-market futures on the S&P, you get these big gaps. You get these gap ups, and you get de-inflated prices. You test deflated prices. So if we do want to hold certain key levels at the 2008 yearly calendar, 2007 lows, and we want to bounce, naturally these are going to bounce up in value. That's the 1155 call. And when you start taking a look at the 1120 call, which is right here, we don't have any data on this one. This one here is an expiration of 9:30, and that's the reason why. So what we would be doing is we'll go over and take a look at The 1175 call on the S&P, remember when we broke below that 1173, we got down to the closing price on the S&P on Friday, right around 1154.23. Now, let me show you something, that the call side of the market for expiration is getting into deflated areas, but could come down here to lower market prices, meaning that if the market sells down, these calls are going to come down, but during the expiration, this one here, right here, was 1220 on the low, and the high was 2053. And relative to the directional movement in the S&P 500, we are experts at getting that lower end of that bid drop down. So if we go down in the S&P and hit support, but they drop these calls down to $7.50 or $8, we'll be all over the 1175. It will have a range. They were inflated up here at $60, and so they had some volatility gaps with the indexes. So we're going to really be looking at that 1175 call up and out of the money. Another one, we would go right up to the half bar failure, the 1185 call, because if we do make a market and we do get great support, they were $30 2 days ago. So let's call the truth the truth. And the truth of the matter is, MMTs, that these contracts were $30.68. And the call side of that market, when we drop down and we drop down below that 1182 on the S&P, these things ripped City down to here. The calls dropped down to $9. So there's been a lot of premium taken out of these, and they're getting wholesale areas of where we're going to look at making the right transaction. That's that 1185 call that is super up and out of the money for the expiration period. Okay? Another thing that we have to look at is in the 930 expiration, we're going to take a look at that $1,100 put that expires a week after this coming Friday's expiration. And what it is, it's at the end of the month expiration. It's a September 930 right here. And if we break the low where that last support was, these got ridiculous cheap right here at 1189. And the high was $26. So you gapped up from here, and you more than 100% got on your money. There isn't a lot of contracts traded. We did have highs up here at 46. So depending on what the S&P does, if that S&P does not get above its key resistance levels and breaks below half bars, then this 1100 put is in play as well. And another thing we're going to be taking a look at is another one that expires on 930, where they gapped that call. They took these right up here to the high at $27, but there was a range over here at the low of 1070 to the highs back over here at 27. We're going to be watching this 930 spot contract on it. You can see the gap up. When we gapped down Friday, you really gapped up strong and made the highs. We're going to be watching this one as well. I'm going to conclude the calls, the put, the S&P 500, how to weight the S&P 500, technical analysis on the index. That video is there. Pair it on up. Welcome to the expiration. Welcome to Football Sunday, and welcome to the S&P 500.